Well, my next guest has high conviction when it comes to the opportunity set on offer this year in unlisted tech. Think growth, think equity, think returns. Salter Brothers' Gregg Taylor joins me now with all of the details. Gregg, nice to see you. Thank you.
Likewise.
First, I think it's really interesting, and I think it's also important for the audience to understand, your deep expertise when it comes to unlisted equities, or I should say unlisted companies at Salter Brothers, and for you personally as well.
Yeah, absolutely. The area in which we target in the unlisted equity market is companies between 20 million and 100 million enterprise value. And I would say with great degree of confidence, we've got one of the largest and most experienced teams in that sector. And so starting with Salter Brothers, $4 billion alternative asset manager across property, credit, equities. The fund I'm talking about today in the sector is the 5th wholesale equity fund launched by Salter Brothers over the last 8 years. So Salter Brothers very much has the capability in the team. But then if you look directly at the equity team managing that, I guess starting with myself, over 25 years in equity markets. Spent the first 10 years very much focused in the listed sector. Then I actually took a sabbatical and a couple of years away from the equity markets and started and ran my own business, an unlisted tech business. And that was quite successful after 3 years, and I exited that and then came back into the equity markets with a greater focus on unlisted. So it really gave me that perspective of the other side as an operator and growing and exiting a company. And then I'm really fortunate I've got a great team around me. So more recently we've just appointed Emily Mohan to the team. I've worked with Emily about 10 of her 15 years in the industry. So we've worked together before and successfully, and she's a real great asset to the team. And then I've also got Tanae, again very experienced in 15 plus years experience in unlisted equity investing. So that's great, but the real point of differentiation, what we do in this space, we take an active approach to our equity investment. And what that means is we typically join the boards and work with the management teams to drive outcomes. And to do that, we partner with what we call operating partners of the fund. And these are former executives in the tech sector who, again, have founded, grown and exited their businesses in the tech sector and had greater than $100 million exits. They're at that stage of their career where they probably don't want to go and have a full-time job, but they've still got a lot of passion and network and experience that they can share to their chosen domain. So we've got some, I'll give some live examples of that when we talk about some of the recent investments. But these people, again, proven CEOs who now help us source, diligence, run and exit the companies in which we invest. So we've got investment professionals and operating professionals that come together to identify, run and exit these companies.
Yeah, I ask because we don't talk about unlisted tech a lot. And what we're talking about right now is the Salter Brothers Tech Fund. So why unlisted as opposed to listed? What are the potential advantages?
Yeah, it definitely a different market. And I was probably on this stage with you 12, 18 months ago talking about my optimistic view about listed tech in the small cap, emerging cap market, and you saw pretty healthy returns over that period. And so what you saw there, a lot of the dynamics that drove that recovery and strong performance very much will influence the unlisted tech market as well. But what you'll find is the listed market tends to lead the unlisted market into booms as well as downturns. And why I'm excited about the unlisted tech market is there's a real lack of capital that's been deployed into this space over the last 3 to 5 years. And that's because we've been in the high inflationary, high interest rate, lower investor sentiment part of the cycle, which is pretty common with every cycle we go through. And so you've seen a real lack of capital, and that's had some really significant outcomes. First is the companies we focus on, they've got to have got to at least $5 million of tech earnings, and they're profitable. And so they're not new businesses, they're established, commercialised, high growth companies.
I think that's really important. So these are profitable companies. You're not investing in startups.
No, not at all. Not at all. That's what we call emerging growth. or growth equity. It's that $20 million to $100 million enterprise value. But again, $5 million of earnings already on an annual basis and growing at a rapid rate. So for businesses over the last 3 to 5 years to have achieved that milestone with a real lack of capital, it's really heightened the quality of businesses that get through that filter. In other parts of the cycle, they would have been able to easily access capital and wouldn't need to have been as disciplined and have built such a sustainable business model to navigate that. So what we're seeing is, I'll talk about valuations shortly, but the quality of the companies, and again, I've been at this for 25 years, is as good as I've seen in that 25-year period. And the other exciting part is, people sort of got really excited about tech 5 and 10 years ago, but the rate of disruption and opportunity in the tech sector is as big as it's ever been. Like, I know it almost feels old because it's 12 months now, but you look at artificial intelligence, AI, and the explosion of ChatGPT and then NVIDIA and all these things, it just further highlights that disruption's as ripe as ever. So there's still the opportunity for unlisted tech companies to really go from sub $100 million to billion-dollar companies, and they're the ones we're chasing. And there really is a great amount of supply at the moment, not many others playing in the space, and the outcome of that is valuations are down greater than 50% from the peak of the cycle. So you're seeing good quality, good opportunities for growth at good valuations.
I find that fascinating because your money was free for quite some time. Absolutely. In COVID.
Yep.
And those that survived once interest rates started to go up and capital was harder to come by, we had said at that time that, only the strong would survive and that it would drive efficiencies and, if companies got their houses in order. So this is now, opportune time is what you're saying to take advantage of those companies that did the work.
Exactly.
Well, I know you mentioned AI, sort of feels obvious, and obviously tech, but is there, what type of companies? Like, are we talking prop tech? Do you have any sort of filters or any areas that you're most interested in?
Yeah, absolutely. So our view is, again, in taking an active investment approach, which we think is critical in this end of the market. What we saw in the last cycle, 5 and 7 years ago, is a lot of people throw passive money at this space. And that's where a lot of the blow-ups and disasters were, because it is different, and these companies still need some nurturing and support to get to the target milestones. And so we choose to invest in sectors where we've got domain expertise. Domain expertise means, from an investment perspective, we've invested in the sector successfully over the last 10 to 20 years. Also, we've got deep networks and experience in certain sectors. So the first one, and you referenced it, was property tech. Solder Brothers has a portfolio of over $4 billion of property that it manages. So we're an avid and very large consumer of property tech solutions. So we have great insight to see what's out there in the market, and also have the ability to add value to the companies in which we invest in. So if we were to bring the Solder Brothers property portfolio onto a property tech platform, it can transform the scale of that business straight away. So there's an unfair advantage. Then the other sectors we've chosen, again, sectors where we've had the investment experience, but got really, I spoke about the operating partners that we have, and these are the former executives of very successful tech companies and some well-known ASX tech companies, and telco is another example of that. So in the telecommunications space, I think a lot of people will be familiar with the success story of M2 and Vocus, and following that, the Unity Group, Unity Wireless, that started off in Unity Group. Both those businesses were sort of started out at sub 100 and were multi-billion-dollar exits. The key operators within those teams are partners of our fund. So people like Vaughan Bowen and Jordan Grimes, again, they work exclusively with our fund to help us source ideas, diligence them. Then when we invest, they join the boards and help us grow those companies. So the sectors where we've got those people in our network working directly with the fund as investors in the fund and sharing in the economics of the fund. So they're not just people we put in a slide deck, they're actively involved. I talk to them daily in the areas of telco, fintech and in health tech as well. So those 4 sectors, property tech, telecommunications, fintech and health tech, are the specific sectors we target because we think we've got an unfair advantage.
Well, your investors would like you to have that advantage, right? Look, I'm going to be cheeky and push you for even a couple of examples, because I think that maybe if I'm watching this as a viewer, I'd think, well, how transparent are your holdings in a fund?
Yeah, no, it's a great question. And again, this is the second fund that I've launched in this space, and I was fortunate to be quite successful with the first one and generated IRRs north of 30%. But key learning there, and what we like to do with our investment is all about communication and transparency. And because in any investment we are almost without exception the lead investor and the major investor in the company in which we invest. So we don't join the register with 10 other institutions. We'll be the only institution. Anywhere between 20 to 80% of the register will control, and we'll typically have control of the board as well. So very, very hands-on. But what we do, we also offer co-investment into these opportunities directly for our fund investors. So if you invest into the Salter Brothers Tech Fund, you have an opportunity to also invest or co-invest directly into the underlying investments in which we make. So what that does is it takes people on a journey. So when a new investment is added to the portfolio, we actually provide access to management and an information memorandum about the underlying investment. So you don't just get a half page or a paragraph saying, hey, guess what, we've invested in a new property tech or a new telco business. You actually get a full information memorandum, opportunity to meet with management and to make a decision on whether you want to also invest alongside the fund directly in that. So what that does is takes a real step change on the level of transparency and communication around the underlying investments. And it really resonates with high net worths and family offices. Because when you invest in this sector, I think, and I say it respectfully, but people like to have a sense of ownership. They don't, instead of saying I'm just in the Salter Brothers Tech Fund, if they're at the coffee shop, the synagogue, or the pub, they like to talk about what they're invested in, and they like to have that sense of ownership. And so we take our investors on that journey where they can not only say we're in the fund, they can talk with confidence about the underlying investments and why they're so excited about them.
So now is the time to get into these investments, in your view. Yes. Very opportune. But what's the exit plan? Give us some sort of a sense of time frame, because exit is it is on the horizon for you, isn't it?
Yeah, absolutely. So the fund, again, is differentiated, and it's a 5-year fund. A lot of these unlisted funds are 10-year plus funds. So our role in the ecosystem is to invest in these businesses, grow them to $100 million plus enterprise value, and exit them into industry players or larger traditional PE funds when once they're ready to take on large levels of debt and other things that are done in the larger PE funds. And so we take a 3-year horizon. So we look at an investment and we do a lot of work on what value can we add over that 3 years using our unfair advantage. And we do a lot of work before we even enter the investment on who's the logical long-term owner of these investments. We're not long-term owners of investments. We help founders and high-growth technology businesses take a step change in their business and achieve the ultimate exit. And so what we'll do, we'll take a strategic stake in the business, work with the management team to get them to their ultimate exit. So we all go in with the same objective. We want out in the next 3 years, and we want a $100 million plus exit. And we do a lot of work, and we've had a great track record. You spoke about credentials and track record. We've exited dozens of businesses in this sector successfully. And again, a lot of people, it's kind of quite easy to make investments. It's a lot easier to exit them. And we've got that track record. But that's because we define our exit path before we start the investment. And case in point, real quickly, a property tech investment we made called Market Boomer, which is a procurement platform for the hotel sector. Mm-hmm. And Salter Brothers is the largest owner and operator of hotels in the country, so it was a natural advantage for us to go into that. Prior to making that investment, I spent time with the 2 major Northern Hemisphere industry players to understand, are they interested in this asset? Because this is a dominant player in Asia and only starting to grow into the Northern Hemisphere. What would it take for them to have interest in this? So I actually sat down, hopped on a plane, met with these companies and said, what would we need to achieve for you to be interested, and got clarity there. Spoke to a couple of specialist prop tech PE funds, again out of the US and as well as in Australia, And again, so what sort of scale and characteristics would this business need to get to, and what would you pay for it if it got that? So, and then what we do with those conversations is that helps us, doesn't exclusively, but it helps us shape the strategy. And then within each quarter, we're keeping those counterparties updated on how the investment's progressing.
Mm-hmm.
So we don't get to the end of the 3 years and put up the for sale sign. By the time we've finished our 3-year journey, those natural owners of that business have been on a 3-year journey. We're reporting back to how we're progressing the company and how it's meeting those metrics. And that's how we've had success in the past in exiting, and why we're pretty confident we'll be able to replicate it.